When you look out to the horizon, what do you see? What does tomorrow look like? If you run a family-owned business, you see the future differently. As part of the fourth generation of my family to help lead First Bank, I know we see the future like you. At the First Bank Center for Family-Owned Businesses, your vision is ours. Now, let our experience be yours. In this seminar, let us help you see what your future can be.
And at this time, I'd like to turn it over to the host of our program, Mr. Joe Ambrose.
Thanks, Mike. Good day to everyone and welcome. I'm Joe Ambrose, Executive Director of the First Bank Center for Family-Owned Businesses. Today, we're going to go a little beyond family business topics and talk about a general business topic. Given the nature of this webinar, I need to share this disclaimer with you. The content of this webinar is for informational purposes only. You should not construe any such information as legal, tax, investment, financial, or other advice. Nothing contained in this webinar constitutes a solicitation, recommendation, or endorsement for cryptocurrency or any other investment. Okay, I've got that out of the way. If you're like me, you have a lot of questions about cryptocurrency, and they likely range from very basic to fairly technical questions. Today, we welcome Noah Buxton from the accounting and consulting firm of Armanino LLP to answer those questions for us. And now, without further ado, Noah.
Thanks so much for having me, Joe. Great to be with you all. Let me get control of the slides here and make sure I can take us on this journey. Thanks everybody for joining. I have to start by saying that it's a distinct pleasure, but also a unique pleasure to be able to participate with a large bank, frankly, on a presentation about cryptocurrency, right? For many years, these topics have seemed at odds, or at least in very different lanes. We're starting to see a really interesting convergence between traditional markets and crypto markets. And so I'm going to talk to you about that today. Let me tell you about who I am, sort of what we do as a firm, to give you context, sort of my view of things and where I come from a background perspective. Then let me tell you about the big picture, the way we see it. Frankly, as Joe said, there's no solicitation. There's absolutely nothing I have to sell you today. All I want to do is leave you with some of the things that I know, right? I want to give you some additional context, some independent, trustworthy third-party views about the way this market is developing. And I want to tell you about our thesis. It's all about digital assets. So this won't get super technical. Don't worry about that. I won't drag you down into those weeds. I will talk a lot about the market and what this technology really enables. But we have to talk about Bitcoin to start, so we'll do that. We'll get to some of the Bitcoin basics. And I implore you all to start there too. If you're on this journey and it's early for you in this journey, consider starting there. So let's do that. And then let's talk about Bitcoin as a digital commodity and some of the other themes around that. And then let's talk about opportunities for investors. Again, not investment advice, but just giving you a landscape of what others are seeing. So by way of background, I think you'll be able to get this deck after the presentation. So you're welcome to read this fine print if you want. But I'm Noah Buxton. I'm a partner here at Armanino LLP. And every day I get to put my passion to work, frankly, leading a team that focuses on digital assets and crypto all day, every day. But what exactly do we do? Well, we're a large public accounting firm. So we do really two different things. We provide the traditional accounting services that you might imagine. Really, these crypto businesses, many different niches of them, but ultimately they're businesses and they need lots of business solutions from audit, tax, risk assurance, advisory, etc. So we do all the traditional things you might imagine a large accounting firm would do. We also do some very unique things as well in addition to that, some innovative things. And so Armanino is a top 20 public accounting firm in the US. And we have about 2,500 people today, about 200 partners, and servicing clients nationally as well as internationally through the more global flag. And so speaking to sort of what we do, I mentioned there's this traditional accounting bucket, and then there's this new and innovative bucket. So let me spend just 1 second telling you a little bit about that. On both of those buckets, I consider ourselves very lucky today. Frankly, I started this practice with a partner here of mine, a cohort of mine, and we've been very successful, right? So a number of the names on this slide may not be known to you, but actually a number of them are the largest players in the industry. And we've been doing this kind of work as a firm since 2014, and with a really earnest focus since January of 2019 with a formalized practice, etc. And so the other innovative things that we do are related to how we can move the accounting industry forward into this new market or this new space. How do we address the challenges, the needs of this new tech that are created by this new technology? And so for us, that's the Trust Explorer flagship of solutions. There's a whole presentation I could give just on this alone. This is my baby, this is my invention, but just telling you very briefly, it's actually the world's first real-time audit platform. So it's the first time a public accounting firm has been able to attest or audit data in real time. And so this system today provides real-time attest reporting for the public, investors, et cetera. Any of you could go there today and download a report over many different assets, many different issuers, but ultimately it's about 28 billion worth of crypto assets in total that are under attest on the platform today. So always trying to move things forward, both for crypto and for our own industry, professional practice and CPA services. All right, so let's get into it, big picture. Again, I'm delighted to have this chance to share with you today. I think I've got many facts that I can share, and I've got many opinions as well. So I'll try and distinguish between the two. But I do want to leave you at the outset with an abiding conviction that there's actually something here. There's been a lot of skepticism. Some of you may have heard that, right? You hear friends talking about it or colleagues talking about it, and there's always the dissenter in the room, right? And so we know that there's also the other side, which is hype and euphoria. We see, lots of, well, maybe less so, but we see positive news or hype around cryptocurrency. Like anything, the reality is probably somewhere in the middle. And it depends exactly what you're talking about, right? But on the doom and gloom side, there's plenty of it in the mainstream media. Exchanges are hacked. Investors have been wrecked. Ransomware attacks are facilitated by Bitcoin. Money laundering is the preferred currency of human traffickers, etc. Many of these things have an easy explanation, or if you peel back the onion one or two layers, you can find a little bit more sense of truth. So money laundering, for instance, something we should all care about, something that financial institutions care about, something that First Bank, for instance, spends a lot of time and money ensuring that they don't facilitate any money transmission that is resulting in laundering or terrorist financing, right? These are laws that they have to follow as well. Here's an example where you can actually see that the Treasury's own report shows that US dollars are still by far and away the preferred currency for crime. So, we can do this, we can go through these examples one by one, but really I just want to leave you with the general idea that there's definitely hype and euphoria, and there's definitely doom and gloom. And in most cases, there's a nuanced position in the middle, which probably represents reality or some sense of truth. So the other thing to say about sort of the big picture and the current state of things, just trying to root ourselves in what's happening right now, is that large institutions are in the game. So some of the largest, most successful macro investors, the Stanley Druckenmillers of the world, have started to allocate into Bitcoin. Now I said Bitcoin, not cryptocurrency, because that's true that most of the large issuers here have taken positions in Bitcoin specifically, right? They've assessed that specific asset for its institutional quality, its investment quality. They aren't necessarily allocating to other assets within crypto. And I can start to make those distinctions as we go along. There's other large issuers here and banks, BNY Mellon, for instance, that have both invested, allowed investor access, or facilitate other issuers, right? They provide banking services for, let's say, stablecoin issuers, things like that. As I go, I'll try and also explain some of these terms I'm using, like stablecoin or tokenized dollars, right? And at this point, I'll also just say, I invite you all to ask questions. Please do. I think that they'll go to the First Bank team, and then they can probably be raised on the call. More than happy to take them midstream so that we get you guys answers as they come to mind. So resetting us back to, again, where are we? There's important institutional movement in the crypto space. Fidelity has just recently announced that they'll allow exposure for 401k accounts. This is, by number and by dollar AUM, a potentially huge demand driver that will flow into Bitcoin. And this actually isn't it's not news to me because I actually know that Fidelity's been working on this for years. It took them years to build the policy, the process, the team, the custody infrastructure to actually offer this service. They've invested in it for a long time. You also see that Bitcoin has started to hit the public treasury. There's been a few notable examples. Tesla, MicroStrategy have taken significant amounts of Bitcoin onto the corporate balance sheet. They've done this arguably as a hedge against inflation or a hedge against the cost of capital or the cost of idle cash. And so they're not the only ones. There's about 42 public companies or more that have done that today. And there's a tracker link there. You can actually check out some of the other examples. I think that we'll start to see this become more common where certain businesses, maybe cash intensive businesses, maybe those that are sitting on large amounts of cash, think about a reallocation strategy or a treasury strategy that includes an asset that arguably is a hedge against inflation. All right, so that's kind of a little bit of where we are. Those are just some headlines, but let's talk about a little bit more of the thesis. Let's talk about capital markets in more general terms and the intersection of traditional finance and crypto. So one way I like to think about this is, again, contextualizing crypto against other asset classes that we're familiar with. And so I think this is a nice little visual, to remind us that value over time isn't necessarily always something that needs to go up, right? Like when we think about consumption, we think about dollars that we use to consume, value over time goes down. That's totally fine, right? And it's because that value is in the eye of the holder, is what I like to say, right? If beauty is in the eye of the beholder, then value is in the eye of the holder. And so we can think about different assets and their qualities over time. This is just one potential presentation of that. But looking at Bitcoin or hard money assets or commodities, you would typically chart them as long run assets at the top of this graph, where equities, things with potentially slightly less scarcity, again, look for growth and return over time, et cetera. So, and then maybe, the assets, let's say that you use in a business, depreciating assets fall much lower on this time frame, right? They're very valuable, but you don't expect them to appreciate in value over time. So it's all about framing. It's all about context when we're thinking about crypto. Crypto is not a monolith. It is not one thing. And I hope that's what I leave you with today, is a better understanding of all of the little niches within crypto and how if you look at each of them in isolation, you can say, again, there's something very real here. There's either innovation or there's a digital commodity play or there's an inflation hedge, right? Nothing is perfect in crypto either. It's an evolving space. So let's get into that. My thesis, our thesis at the firm here, is that really this is all about digital assets. And so this is one key distinction here. When you hear, maybe you've heard a presentation about crypto before or digital assets, you might have heard people talk about crypto or blockchain, not crypto, but blockchain in the enterprise environment, right? How do we take this innovation that Bitcoin created and use it as a database technology in a business for supply chain or order management or consortium activities, things like that. That's not something that we focus on because, again, our thesis is very strong around this, that actually the fundamental innovation of public blockchains is digital assets. It is the ability to tokenize assets. It's the ability to program money. It is not the ability to register the movement of assets or the movement of, let's say, real world things across an enterprise. We think that database technology works pretty well for that. And the fundamental innovation, again, of Bitcoin, of blockchain networks is really facilitating digital asset creation. I think that this has started to be borne out as true, right? So what I told you was just an opinion. But what I can also tell you is that from a factual perspective, we've heard a lot about enterprise blockchain, right? Walmart is creating a blockchain consortium. All the Blueberry producers will be required to register, the production on the Walmart blockchain, and it will prevent E. coli spread or, the ability to create food safety because we'll be able to identify problems in the supply chain with complete accuracy. That blockchain isn't live today, right? These are proof of concepts. These are things that companies have spent millions of dollars on, but they haven't made it to production yet. On the other side, there's been an incredible amount of innovation and funding and growth in crypto markets, or in public blockchain markets is another way to think of it. And you might ask yourself why. If Walmart has a large war chest to spend on innovation, why isn't that live? I think the core answer there is because there's no crypto incentive. One of the fundamental innovations of a decentralized public blockchain network is that it has a crypto incentive, or a monetary incentive, that drives participation, right? It drives people to interact, to innovate, to collaborate, etc. And so I think that that's, in my mind, really the reason that public blockchains are moving and private blockchains are stagnant. But back to this ability that blockchain, or the fact that blockchains enable tokenization and they enable the creation of digital assets. What does that mean? Well, it means that every corner of our economy is subject to tokenization, or is ripe for tokenization even. And so these innovations that I'll tell you about more and that I've already spoken about will touch our dollars and fiat money. They will touch private securities markets. They will touch public securities markets, believe it or not. We'll talk about these proxies for equity, commodities, and other intangibles as examples. So how does it touch dollars and fiat? Really, it's in two ways, but from our government's perspective, we will see a central bank digital currency at some point in time. Over 50 central banks are already working on this across the world. China is ahead, and the US is playing catch up. The Digital Dollar Project is a private initiative that's working with Treasury and trying to essentially inform the government policy on this. It's actually headed by former CFTC Chair John Giancarlo, I think. These things are moving. Again, if you have questions, please feel free to tee them up as we go. The digital asset market, or ability to tokenize, is definitely going to touch private securities markets as well. It already is. And when I mean private securities, I mean private company ownership, venture capital, private funds that, say, invest in real estate. These private securities have historically been illiquid. There's been, lack of secondary market trade ability, or lack of ability to exit these investments, right? And so the ability to tokenize them means that they can very easily be, compliance can be programmed into the code. They can be quickly made borderless, pretty frictionless, and you can easily make secondary markets with lots of transparency and potentially lots of liquidity. We haven't seen the liquidity piece yet, but there's a couple companies that are pretty far along on this. And I think over the next couple years, we'll see transformation of a number of private securities offerings. We'll see managers start to use tokenized offerings. In this regard, the private security is still the same, right? It's still a Reg D investment or a limited partnership interest. It's just wrapped in a token. So that's one way I explain it as well. It's a token wrapper around an existing legal vehicle. Public securities. I won't spend a lot of time here, but even the main clearinghouse behind all of the public equities trading that we do in the US is going DLT, or distributed ledger technology, another word for a blockchain. They even are seeing that this innovation could be useful for public markets and the way that we register ownership of securities. Okay, now there's this other thing that we can tokenize, tokens or crypto. Now this is where we open the universe of crypto in a way, and there are many different use cases. From Bitcoin's store of value argument to cryptos that are solely focused on payments or enabling faster, smoother, borderless, lower cost payments. Tokenization, which I've already referenced, right? The ability to tokenize a real world asset or tokenize an interest in a real world asset. This opens the door to programmable money. And I've talked about Bitcoin. The second blockchain was Ethereum. And this really was much like Bitcoin to begin with, but with additional capabilities, right? It was the ability to essentially program money on top of the blockchain using these things called smart contracts, which, keeping it not technical, they're money vending machines, right? You can tell them, if you see this, output that. If you see a quarter, output M&Ms, whatever. Governance tokens are another type of cryptocurrency that enable holders of the tokens to participate in the network in a certain way, right? It could be governing a decentralized group, right? It could be voting, much like you would think of an equity holder could do, and staking, right? The ability to stake assets to participate in these networks and earn returns for doing so. Those crypto incentives that I mentioned.
We have a couple of questions, if we could.
That'd be great.
Could you define tokenize for us?
Sure. So to tokenize is to create a digital representation of a real world asset or real world agreement, fill in the blank, of a real world fill in the blank, using a blockchain. So tokenization is actually something that has happened pre-blockchain or pre-2009, right? You could create digital representations in a database. You could tokenize them. You could give them a unique identifier, for instance, but that would be in a centralized database. So tokenization on a public blockchain allows you to create a digital representation of a real world asset, but for that also to be secured, registered on a public network such that it's immutable, right? So that everybody in that network can agree that yes, that is the representation of a specific asset.
All right, very good. We have a couple more coming in as well. So this one asks, how many CBDCs are live today? You said China is leading the way and the US is playing catch up, but maybe I missed which countries have gone live.
That's a great question. Because I don't work in that space day to day, my best understanding right now is really that it's just China. There might be a couple of others quickly behind, like Vietnam. Other countries, generally speaking, countries where there's net less democracy and more ability for government to move quickly without participation necessarily or buy-in from the people, that's where you see CBDCs thriving.
Very good. Thanks for that question. Another one just popped in. Can you talk about mining in Bitcoin? What does that really mean, and what does that process have to do with the valuation of it?
Sure. Yeah, mining is one of these things that always confuses people because of the terminology. So mining is really just participating in confirming transactions on a given network. And let's just say it's Bitcoin to begin with. So mining Bitcoin is simply contribution of processing power to the network and getting some return for that processing power. So making an analogy to gold mining is actually why we call it mining. So because Bitcoin is a digitally scarce resource, there will only ever be 21 million Bitcoin, and there's only a certain number of Bitcoin released every block of transactions. Those that participate in confirming transactions are doing a capital intensive activity that could be analogized to gold mining, right? So what do gold miners do? Actually, I have a picture of one up on the screen because I was going to say commodities. They put tons of capital, tons of resources into digging big holes, extracting, processing, refining, and selling gold, right? Well, a miner, a Bitcoin miner, puts maybe not quite as much, but capital and resources into computer, plant, and people, and they run servers to confirm transactions. And what they get in return is an ever scarcer resource, right? Or digital resource or digital commodity that they can then sell at market. And so the more capital and resources you put in, the more you can mine. That is true for Bitcoin, and is also true for traditional commodities mining.
All right, very good. Thanks so much for those questions. That's the last one for now, Noah, so back to you.
Good stuff. Yeah, I do appreciate the questions. Thank you. So reframing us, I'm taking you through again why or how tokenization and how the innovation of public blockchains can enable tokenization of lots of different asset classes. And so now I'm looking at commodities. Commodities are ripe for tokenization because they're illiquid, they're not very portable, some of them may be divisible. The transparency to the supply of these commodities is very low. And so there's a huge incentive here, a huge potential for tokenization. So let me tease this apart real quick because that sounds a bit generic. So if you think about the way gold is traded today, it's really traded mostly on regulated public markets like NASDAQ through assets like GLD or a paper gold or an exchange traded fund backed by gold, right? This is an asset exposure to gold that requires multiple intermediaries, multiple counterparties, and doesn't necessarily give you direct exposure to that asset price or even visibility necessarily to its supply, right? These ETFs are audited once a year. Imagine if you tokenize gold. Imagine if you create a very reliable public representation of it on a blockchain that everybody can see. And on the other side, you register that token to an ounce of gold that's held in a third-party custodian, a qualified custodian like Brinks. There are companies that are doing this today, and what they're creating is a very direct representation of gold exposure. So this is for the investor, let's say, that doesn't want to really hold gold in the safe at home, but they want a very direct, very liquid engagement with that asset. And so they can do that. They can trade that on many different marketplaces. They can hold that token in a digital wallet. They can trade it on a marketplace, etc. Right? So it really opens up a world of possibilities when it comes to commodities. You know, you can do this with diamonds and silver and palladium, etc. So this will start to happen in institutional markets as well. Like these assets will be tokenized and they will be traded in a tokenized form on secondary marketplaces. There's also a world of other intangible assets, carbon credits, power production agreements, futures contracts, etc. So without going into all of these, I'll tell you that some of these are already real. So I told you about Trust Explorer, world's first real-time attest platform. We have 2 clients on the platform now that have tokenized carbon credits. So carbon credits, a great example of something that's, again, sort of illiquid. The supply of it is a bit opaque. You know, how do you know that it's a real carbon credit, its expiration, all of these interesting questions. Well, we've known that historically through centralized parties who have told us, here's the carbon credit, it's a real carbon credit, but you can only use it on our system. Now, if you tokenize those carbon credits, and you can get assurance, like a third-party assurance like we do over the supply of those carbon credits, you can tokenize them and they become very liquid, right? They can be traded on many different marketplaces. They can be sent borderlessly. They can be consumed by an enterprise in a programmatic way. So it opens up, again, a world of possibilities. It's making static, immovable, illiquid assets, making them the opposite of that.
So, hey, no, I'm sorry, we have another question. I think Joe just got a question for you.
While we're speaking of intangibles, the current accounting treatment for cryptocurrency remains as an intangible. You see that being refined as we move forward?
Yes, exactly. That's largely true. So generally accepted accounting principles, or GAAP, has not clearly identified a treatment for an asset like Bitcoin or Ethereum or the top market cap digital assets. And the industry view has been that the most appropriate treatment is a long-lived intangible booked at cost, and then subject to impairment down the road. So yeah, that's the way that most of these digital assets are held on books. There are exceptions, you know, in a fund context, maybe for stable coins, maybe for other digital assets that are actually representations of equity, for instance. But yeah, largely that's the case. I think it will change. I think that we can get to a more of a fair market value treatment in the future. It's really about FASB, or the Financial Accounting Standards Board, getting up to speed, and also seeing that there's a pervasive enough need, right? That there's a number of public issuers in the marketplace. There's a number of investors that really need more clarity in the accounting treatment. And to make sure I'm abundantly clear, the reason that you would want an updated GAAP treatment here is that you could buy Bitcoin, let's say at $5,000, and hold it at cost. Your balance sheet would show, let's say 2 years later, would show $5,000 worth of Bitcoin, when in reality, the economic reality of your balance sheet is that you could liquidate that asset for, say, $30,000 of Bitcoin. And so it's really, GAAP should be, right, reflective of the economic reality of the balance sheet. And so the accounting treatment is a bit behind, but something we're actually working on and participating with leading industry groups like the Digital Chamber on. Thanks for the question.
That's the last one for now, Noah. Back to you.
Cool. So I told you we have to start with Bitcoin. Some of you might not like that. I don't know. I think it's the best place to start. It's the first blockchain. So when we say blockchain, there was no blockchain before Bitcoin. There were some experiments around peer-to-peer cash and creation of these decentralized cryptographic systems, but there was no blockchain, right? Bitcoin is the oldest the currently largest market cap crypto asset. It's the asset with the most daily volume. And it's also, again, where actual investors have said, okay, this asset meets certain characteristics that we would start to think of it as institutional, right? We would be able to start to place reliance or offer, products based on this asset. And so let's talk a little bit about the Bitcoin basics. I think I've referenced a few of these already. When I say Bitcoin with the big B, that's the blockchain. Bitcoin with the small b is the asset itself that runs on top. And BTC is the ticker or the symbol that's used on global exchanges to represent the asset. So I told you it's a scarce or inflation resistant technology to begin with. The way that Bitcoin programmatically releases assets is on a schedule, and it will only ever be 21 million Bitcoin. And so that means that not only is it inflation resistant, in a way, it's actually deflationary over time. And deflationary over time, with demand being a constant, a deflationary supply will, based on supply and demand, lead to a rising price. Anyone can transact. It's censorship resistant, right? So yes, there are exchanges and intermediaries that have KYC requirements or know your customer requirements. So there are gates and blocks in this system, but at Bitcoin's bare level itself, anybody can participate. It's borderless and censorship resistant. It's confiscation resistant too. Only the owner of a Bitcoin can spend it. So if I hold Bitcoin with a qualified third party, I don't actually have my keys. And maybe it's not confiscation resistant there, right? Just like holding a liability anywhere else. If I use a digital wallet, like the one I have here, then yeah, I'm confiscation resistant, right? I can send and use my assets however I choose. And anyone can always verify, right? This is an open source code base that's worked on in an open source way. So it's very transparent. All right, some other reminders on Bitcoin basics. I've sort of alluded to this, but don't worry about the technology for today. I don't want to talk about the blocks of the transactions and how they're interconnected and how the cryptography works. I think that people get lost in that. 13 years down the road, we can say that it works, right? So Bitcoin as a fundamental technology does work, and it's worked without a hiccup. There have been things around core Bitcoin, like exchange hacks or fraud or other things that have happened. But the core itself has been uninterrupted, and as a protocol has worked for 13 years. It's roughly a $1 trillion asset. I think if you look at the market cap today, it's something 750 or less. We've seen some volatility. We've definitely seen a downturn in the recent months, but roughly a $1 trillion asset class. Also, Bitcoin's risk-adjusted return has been the highest of any other asset class over time. So measured by Sharpe ratio, it's actually outperformed other assets. Now, of course, here's the reality piece, is somewhere in the middle. You could attack that and say, yes, but what about all the other assets that are older and Bitcoin is so new? Of course, it can show that performance over a very short period. All those things are true, but measured by Sharpe ratios, it still is risk-adjusted return highest of any other asset. And others have started to describe it as a potential future reserve currency for the world, which I think is fascinating to think about. And that's why Bitcoin is the rabbit hole you need to go down to start this journey. What would it mean if we returned to a reserve standard, right? We've been off the gold reserve standard since the early 70s. What would it mean if we returned to that, but with a digital anchor, with a deflationary, hard money digital asset? Some of you think I'm absolutely crazy right now for saying that. The case for this gets stronger and stronger every day. And so you've seen countries like El Salvador. El Salvador is the first to accept Bitcoin as legal tender. These dominoes will continue to fall. Bitcoin as legal tender doesn't mean that the Federal Reserve is holding Bitcoin on the balance sheet as a reserve asset. That's not what it means. But it does mean that there's a crack in that dam, that eventually a country like El Salvador, which has been dollarized and is subject to the movement of the US dollar without democratic participation, might well think, geez, there might be a better reserve asset for me. And so I think that the US dollar hegemony continues for foreseeable future, but I do think that the US has a big problem to grapple with in terms of macroeconomics and the way that the US dollar has historically been a reserve currency, but might not always be. Bitcoiners come with strong opinions. So you see I'm sort of presenting one case there. That's a very strong or very significant case, right? If you thought about Bitcoin being a reserve currency for the world, that might come with a lot of economic pain as well. You'd have to imagine the degradation of other markets as well. And so just want to acknowledge that. Yeah, is BTC or Bitcoin a hedge to fiat money and macroeconomic uncertainty? Some believe it is, but again, it's all in the eye of the holder, and it also might depend on the time you're looking at it as well, right? Gold has been a great asset to hold in certain times and not a great asset to hold other times, right? So there's a temporal aspect to this. All right, Bitcoin overall, just down here on the bottom right of the side, Bitcoin has, its inception was a response to the 2008 financial crisis. The first block of Bitcoin had written in it, Chancellor on brink of second bailout. And that was I think it was the London Times headline, basically saying that, the central bank in England had to come in and inject capital into the system because banks had become insolvent. And so Bitcoin launching around this time, 2008, 2009, arguably was an alternative system. As I said, we've started to see the conversion come back now to where, for many years it was Bitcoiners were, again, on a road of their own, right? Traveling a path of their own. And it didn't involve banks and financial institutions or any intermediaries, right? It was all about decentralizing and removing the middleman. I think that the reality is starting to set in, is that actually Bitcoin can be decentralized and also there can be participation from qualified intermediaries, right? Auditors, for instance, I'm selfish on this one, right? I'm self-interested. Auditors have played an incredibly important role in society and in public markets for decades and hundreds of years now. The same is true with financial institutions, right? They've played centralized intermediaries have played an important role in credit creation and in stability of markets, in personal finance for hundreds of years. I don't think that goes away. I think that the character starts to change a little bit. I hope you're still with me. If you're not, you just let me know. Slow down, talk about something else. Let's see if I can get to this next slide. All right, I told you about the risk-adjusted return. There's a graph of that on the right. And by the numbers, you can see incredible performance on the left-hand side. Year to date, not so incredible, down 33%. Ouch, right? It's all about zooming out with Bitcoin. I think the asset is still so young that if you look at it, if you're looking at the sort of economic characteristics of it, right, you're looking at the market cap and supply and price and measuring those types of measures, then you have to zoom out, right, because it is a very volatile asset. By the way, all low market cap assets are volatile, right? Okay. So there's also an emerging idea about Bitcoin as digital commodity or digital gold. And I've sort of referenced that already, but is there any validity to that? Like let's go through the mental experiment together here. Let's talk through it. Gosh, that at first, you might be thinking, how do I get my mind around that? A digital commodity, this thing has no substance. It's ether. I can't hold it. I can't touch it, right? This is my mom's Bitcoin journey. She did the same thing, right? She said the same thing. I can't hold it. It's not tangible. Okay, well, we can hold a US dollar, right? But it is by itself not inherently valuable. It's the promise that's valuable, right? And like many other things we hold, right? We hold a balance at First Digital. What is that? That's a ledger entry, right? That's an IOU from the bank. An important IOU, but an IOU nonetheless. So as we start to go down this road, I encourage you to think about maybe money as a spot on a ledger as opposed to something that needs to be fundamentally or inherently, quote unquote, inherently valuable. Because really a commodity money is defined really by its durability, its divisibility, its ease of exchange, and its scarcity. That's what would define a commodity money, right? That's how gold emerged and other precious metals emerged as useful in economic transactions, right? It wasn't that, in early Mesopotamia, you could use gold to make microchips and it was therefore inherently valuable. That wasn't why gold was valuable. It was valuable because it was durable, divisible, portable, and relatively scarce, right? It couldn't be debased by one individual. That's what gave commodity money its power. So you tell me if I'm wrong, or at least grapple with this idea, could Bitcoin have enough of those strong characteristics to where it could be a commodity money, even though it's digital and even though you can't touch it? Let's also kind of explore this idea of money, right? I think this is the fun part of the rabbit hole, right? If you think about this later tonight, I encourage you, to go down this rabbit hole mentally and say, okay, what is money in a way, right? Many of you are in business, right? You're small business or medium-sized business owners, and so you know well money, accounting. You've probably had economics courses or did even a degree in economics. So many of you know this. But the truth is that the vast majority of us don't know money. We don't think about it. We don't understand it, right? We just use dollars in our daily life. And frankly, we take it for granted because we live in a developed economy with a very stable global reserve currency. We're very, very lucky to have the money that we do. If you lived in an emerging economy with a corrupt government and an unstable money that was subject to huge inflation, you would think a lot more about money. So I think that's one thing that's hard for folks in the US that are relatively comfortable to get their mind around Bitcoin because they don't actually have those problems in their daily life. They don't have huge inflation problems in their daily life, right? We've seen CPI of 8%, I think, by the last measure, and that hurts. That hurts a lot of people, but nothing like you see in emerging country or developing economies. Okay, so what is the function of money? This is the facts, right? This is the textbook. The functions of money are to store value, to create a unit of account, and a medium of exchange. There is no other function of money. Everything else you want to do with money falls into those three buckets. But then what are the qualities of a good money? Because you could name things that are a store of value potentially over some period of time, or maybe a good unit of account. They're pretty divisible and everyone would recognize it. But maybe they're a terrible medium of exchange, or maybe they're a great medium of exchange, but a bad store of value, right? So what are the qualities that lead to good money over significant periods of time? And those are listed for you. So durability, portability, divisibility, etc. Acceptability being the last. So I took the liberty of listing fiat or dollars or a government issued or government backed currency against gold, a recognized commodity, against Bitcoin. Maybe this is very subjective. I put high for a lot of the Bitcoin, but I think as you start to think through this, is Bitcoin durable? Well, yeah, it's very durable. I mean, it's even the FBI early on when they wanted to kill Bitcoin said, actually, we're just not even going to spend resources on this because there's no way we can stomp this out. It's a decentralized network. People will stand up servers wherever, whenever they want, and there's no way to kill this protocol, right? It's a living thing on the internet. It's the most decentralized today. Thousands of computers around the world run Bitcoin. Is it portable? Yeah, very portable, right? Much more than other things that we deal with on the daily basis. Faster than Venmo dollars, right? Faster than most bank transfers. Is it divisible? Highly divisible, up to 8 decimal points. Is it uniform? Absolutely. It's an absolutely fungible digital asset. So we could keep going down the list, but when you think about the actual definitions of function and definitions of how you qualify good money, Bitcoin actually stands up pretty well. And this is what the largest investors in the world have realized, is that actually it does have the qualities of commodity money. It has arguably a store of value function that's emerging, even though it's still volatile. So
hey, I know I want to be mindful of time here, but there is another question that's popped in. With
Great.
inflation currently at about 8.5%, how come Bitcoin is at a near low?
Yeah, that's a great question. So, what we see today is that Bitcoin, frankly, is correlated, and crypto markets are correlated. So we see macroeconomic uncertainty, we see U.S. economic uncertainty, we see the effects of huge capital injections, right? What is it? Half of the dollars that have ever been printed have been printed in the last couple of years, right? Some staggering figure, right? We've had huge capital injections that have driven up price inflation. That has propped up markets for some period of time, but we're actually now, the way I see it, in a time of tempering expectations, right? We're seeing the Fed saying that we're going to start to tighten things down. There'll be some quantitative tightening, and markets respond to that. And so crypto markets have responded essentially in kind with capital markets, with equities markets. So they are correlated for now. You might say, well, okay, well then why? The question I guess you're getting at too is like, well then why Bitcoin? If it's correlated to equities, why wouldn't I just stay in equities? I think it's the time when it's not correlated that matters. And it's also the time horizon that matters. So if you look at a very short window over this last year, we're down 33%, right? If you look over the long run, if you plot the S&P 500 against the performance of Bitcoin, you see that the S&P 500 has lost 99% of its value against Bitcoin. So it's all about perspective, right? You can do different plots, but yeah, over time, I think is where a commodity or hard money shows its value.
Okay. Yeah, last question for now, thanks.
Great, thank you guys so much. All right, so what are the opportunities for investors? Again, I don't have anything to sell you. I don't have a fund. I don't have investment advice. I'm trying to show you what I see in the market today and try and demystify some of these things. So what could the opportunities be? Well, I say first I'll proceed with caution. And that's not just a disclaimer. That's to say that there's actually very few people that are truly knowledgeable in this space. That old saying, it's not timing the market, it's time in the market, is very true for crypto, right? Anybody trying to time crypto markets using technical analysis and all this stuff, wow, that's a difficult game. I think time will show that, like other day traders, they probably don't beat the market over time. And so, you know, take everything you hear in this space with a grain of salt. I think generally you could think of a few different investment strategies if you wanted to get exposure. And this could be from a personal or a business context, probably mostly personal. Small percent allocation based on your risk tolerance, for sure. That should always be based, everything should be based on your risk tolerance. There's an idea of an index approach, right? Getting access to the top market cap assets and rebalancing, you know, as market cap weighting, right? Just like the S&P 500 does for you. That's a great way to get broad market exposure. You remove some of the up and down of individual assets, and you know that's usually a pretty good approach. Public stocks. There is actually, you know, many public vehicles now. Not many, but there's a dozen or more public vehicles to get exposure to Bitcoin. So first off is Bitcoin mining stocks, right? So these are Bitcoin miner businesses just focused on confirming transactions, earning Bitcoin, and selling Bitcoin at market to fund operations. These companies, a number of them have gone public, and so you can simply buy stocks and get pretty direct exposure. It's a proxy for Bitcoin, is a way you could think of it. There's exchange traded funds, also public vehicles that are giving exposure to Bitcoin. They're futures ETFs, so they come with a potential downside. They're not what we would want in the industry. Would be a spot Bitcoin ETF that would directly track the price a little bit closer, but that's what we have for today from the SEC so far. There's a really interesting angle on the personal side, exposure through qualified retirement funds. I told you that Fidelity has allowed 401k exposure. There's also, you know, the self-directed IRA route, which works really well for, again, someone who's sophisticated enough and feels comfortable enough to make these allocations through a self-directed IRA. It can definitely be done. And the benefit there is, you know, the fact that you don't have a capital gain implication on the proceeds of any transaction. So that can be a very, very big deal. Direct investment and participation in mining or staking, right? You can get involved in the Bitcoin network. You can run servers yourself. You can allocate capital into that. You can get exposure to venture capital funds, sort of early startup equity that, again, is sort of a proxy for the crypto space, you know, investing in startups that are working on crypto problems, issuing assets, creating platforms, etc. And then there's the initial coin offerings, so the IPO world of crypto, right? Just get early exposure to these coins. They're moonshots, like VC plays, you know, most of them don't do much, but the ones that do are significant. Okay, so what are the niches that you could think about? I sort of told you general like strategies, like what you could think about an investment that might work for you or might resonate with you and the other investments that you do. There's also this idea of macro plays. So, you know, you could think about, well, I want to be a macro investor. I want to make the macro plays. That's really Bitcoin in my idea. That's the idea that either Bitcoin is very successful, becomes more of a reserve currency, is utilized by countries actually to anchor their fiat currencies, and that's a play where Bitcoin is $1 million or more a piece, believe it or not. That's conservative estimates over time. There's a niche of decentralized finance, which is fascinating. Requires an hour of its own to explain fully what it is, but I can just tell you in a nutshell, it's the use of these smart contracts or programs built on blockchains that enable decentralized exchange. So there's a ability to swap one token for another without a facilitator, without a business, without brick and mortar exchange business built to do that and people doing that. It's done by code. These protocols also offer lending, right? So you could park one asset, you could park one of your Ethereum tokens in a protocol and take some stable coins or take some tokenized dollars out with a certain loan to value ratio under collateral or over collateralized, but enables that kind of thing. So you can invest in decentralized finance in two ways. You can kind of invest in the protocols themselves, get exposure to, if that protocol does well, you do well. You can also think about them as, opportunities for yield, right? Just on idle cash, for instance, or dollars, right? They come with a ton of risk, is the other thing to say. And they're largely experiments, let's be honest. Like that's what they are today, is still largely experiments. There's crypto funds that are popping up, and these give you myriad types of different access, right? Some of the things I've already talked about, right? It's Bitcoin long, or it's top market cap, or it's invest in NFTs, lots of different strategies, and these are things that you can get access to. Non-fungible tokens, digital art, digital real estate. You've probably seen NFTs in the news. Here again, we could do a whole hour and I could tell you all just about NFTs. But essentially, what have we done? We've tokenized the ownership certificate over art. That's what this is. Again, it's all about digital assets. It's all about using the public blockchain to anchor a representation of a real world asset. And this, in this case, is a picture, right? It's a digital asset representing a digital asset. Okay, it's a bit of a mind bender. And here again, most things are experiments, but there are some cool innovations that will trickle down or be persistent in the market. And so gaming is one of them, number 5. So NFTs will definitely be in games. There definitely will be play to earn going forward. And this represents a huge potential investment area for investors, I think. It's nuanced, it's difficult to get access to. You might have to spend time with these games or protocols, but there's incredible value to be had. All games will be crypto games. There's just no way, two ways about it. There's no other way that you would have a game. They will all be crypto games. And then there's this last thing, decentralized autonomous organizations, getting exposure to this niche. So we could do a whole presentation on this as well, because this is the upending of the corporate structure. This is the upending of the traditional way we organize businesses. And we're starting to see that these crypto incentivized mechanisms can be used to organize people around a common goal. Here again, mostly experiments, mostly a drop in the bucket compared to everything else, right? This isn't something that needs to disrupt your current business or something you need to necessarily think about today, but it is a tomorrow thing and it is a next day thing where the way we participate in things we're interested in will change, right? The typical employee relationship will change over time because of these DAOs. You can imagine a software engineer today, right? Would they go work for a large centralized Web 2 company, or would they go work on 10 different things that they're super passionate about and receive crypto incentives and rewards for that? Largely, we're starting to see that they take that second option becomes increasingly attractive. So, all right, I think that's what I have for today, and I'll have just a few minutes for questions if there are any others. I hope all of you found this somewhat useful, a perspective on this crypto world. And yeah, I'm Noah Buxton. I'm a partner at Armanino LLP and available to you anytime if you have questions. Thank you.
Noah, thanks so much. And I think you've answered all the questions. There are none coming in.
Cool.
We just have one now.
So this question says, what's the difference between a Bitcoin and a stablecoin, or are they the same? And this might be the last question that we can take right now.
Sounds good. Yeah, question is, what is a Bitcoin? What is a stablecoin? Are they the same? Okay, so Bitcoin and a stablecoin are definitely not the same. A stablecoin is a tokenized dollar. Now, there's a nuance here. There's a few different types, and again, there's experimenting happening here. but the largest types of stablecoins are what we call fiat-backed stablecoins. So the idea is that the token issuer mints a token on a blockchain, and at the same time puts $1 in a bank account to back that up. So actually, here's a great example where banks are key to this crypto infrastructure. There are banks under every stablecoin that we know today. This is roughly like a $70 billion market for stablecoins, so it's still not huge, sizable, but not huge. And so a stablecoin is really meant to give all the benefits of a Bitcoin, so borderless, decentralized, frictionless, easy to transact, usable on secondary marketplaces, a bit sovereign, you can hold it yourself, but without the downsides of Bitcoin, right? Without the volatility of Bitcoin. So it's meant to maintain this stable peg. And the way these things are used is many different ways, but originally they were sort of a safe haven or an anchoring asset for crypto traders, right? They would go out, trade Bitcoin all day, and at night go to sleep and anchor to stable coins as a way to sort of exit the market. Now they're starting to be used in decentralized finance protocols that I mentioned. And stablecoins really are the lifeblood of these protocols, right? Just like dollars are the lifeblood of our traditional banking system, stablecoins are the lifeblood of our experimental financial system.
Noah, great. You've given us a lot to think about today, and some things to think about that we didn't even know we needed to think about. So I greatly appreciate you taking the time. You covered a lot of ground in a short amount of time, relatively speaking. We're very happy with it. So thank you so much. And thanks everyone for joining us. Please mark your calendars for our next webinar, June 14th at 2 Central Time. We'll go back to family business topic, and it will be, does your family business need a board of directors? So until then, thank you very much for joining us.